All right, this is going to be a different go of it from what we normally do here. And today, we want to really focus on multifamily. So, we'll be doing a series here in which we bring on top tier operators across a variety of asset classes to really dive into two main things, right? One being where does this fit in like investors' portfolio? How is it they actually make money? And second, from the operator standpoint, breaking down the numbers behind the business model too. So today we have Rob Beardsley of Lone Star Capital Real Estate. You want to give a brief introduction to you for those who don't know you yet?
Yeah, would love to. Well, thanks, Sam, for having me on the show. Hey, everybody. My name is Rob Beardsley. I'm the founder and CEO of LSCRE. We deliver monthly cash flow and peace of mind for long-term investors through tax-advantaged multifamily real estate. We've been acquiring properties in Texas since 2018. We're at about close to $1 billion in acquisitions, and we also are vertically integrated with property management in-house. So it's a there's some sexy parts of the business, but there's also a lot of unsexy in the world of operations, property management, and accounting.
Yeah, and so I want to dive into that here in a second. But first, I want to how do you think about multifamily as it relates to where this fits in someone's portfolio? Like, if you think of Joe the investor as a dollar to allocate, what portion of that dollar are they looking at, and like why do they look at multifamily to go invest into?
I love this conversation because it gets me to step outside of myself a bit, which I'm a multifamily guy, right? It's all I do. It's all I put my money into, basically. And so for me, it's taking a step back and realizing, well, not everyone is, in multifamily. Not everyone should. Although I spend a lot of my time getting people to invest with us, and getting investors onto our platform. The reality is not everyone should invest with us, and no one really should invest all their capital with us or even in multifamily generally. But to go a little bit deeper into that, I think the number one concern or factor when it comes to investing in multifamily are the tax advantages and the tax consequences. So, for example, we met up with a very large family office based out of Dubai recently, and frankly, they should not invest with us. There's no reason that they should, because in Dubai, there's no capital gains tax, and the whole complexity of the foreign investor and missing out on all the tax advantages, it makes multifamily uncompetitive. So what you really want to be is someone who can benefit from the tax benefits of depreciation and 1031 exchange of multifamily, which really makes multifamily the best investment on an after-tax basis when you compare it against stocks and bonds.
Okay, so let's take a step back to and break it down in different types of investors. So you mentioned the bigger family office out of Dubai, right? And for them, not appealing because they're already in a place in which they don't have tax anyway, right? So for them, the tax advantage piece that leaves. So what other types of investors do you typically work with? Whether it be family offices, institutions, fund managers, retail investors, right? Kind of break down each one of those people and where you see it fitting into their portfolio too.
Yeah, we typically work with high net worth investors, ultra high net worth investors, investing somewhere between 100,000 and $5 million. And these individuals are U.S. based investors, and so they pay U.S. taxes, and so they benefit greatly from the depreciation and the 1031 exchange elements of multifamily. And the reason for that is because it's very simple. The stock market is, you know, projects returns on a pre-tax basis of whatever you say, 6%, 8%, 10%. And then multifamily also has pre-tax projections. But then the difference being, if you can defer all the tax associated with an investment until sale, and then you can actually 1031 exchange the taxable event upon sale again and kick the can down the road again, now you're able to essentially bring your pre-tax returns as close to post-tax as possible. In stocks, you really don't have the same advantages. So you are left with essentially, let's say, 10% pre-tax returns and then maybe 6% post-tax returns. And the same is true for a lot of other asset classes.
And so walk through, right? So someone invests 100K into a deal, and this is thinking through the lens as a limited partner into a syndication type project, right? Syndication and fund operate fairly similar. So Joe, the investor, invests 100K into a deal. You may see what, 50% on the dollar as a loss year one.
Yeah, that's pretty typical these days. So this past year in 2025, the big beautiful bill was passed, which brought back 100% bonus depreciation permanently. Obviously it's only permanent until they change it again, but it's really nice to see that, and that's brought a lot of excitement back to investing in tangible assets that offer where you could take advantage of 100% bonus depreciation. So that's exactly what we're doing. Every time we close a deal, we do a cost segregation study, and we also elect 100% bonus depreciation. So we're able to maximize the non-cash paper loss for investors in the first year that they invest. I was actually just on the phone with a very large investor who just invested with us last month, and he sold his company. So he has this big gain, and now he's working on investing to create a lot of depreciation so that he can use those losses against the gain from his company sale.
Sure. So that's a unique scenario, right? Someone who has potentially 7 figures, 8 figures from a company exit, maybe even 9 in the right scenario. But think of like the average investor, how that applies to them, right? So to my knowledge, right, that person invests 100K, you'll see a $50,000 loss year one, give or take, obviously a range of outcomes based on leverage, based on how it is that the property is appreciated. So in effect, how that would work is that all the cash flow they're seeing too becomes tax deferred, right?
Yeah, and so when we say average investor, we have to obviously caveat that these people are far from average, right? These are ultra successful people who have 100K to invest in, a deal here and there. If you only have $100,000 saved up, first of all, that's a very big accomplishment. But second of all, you shouldn't invest it all in one deal or in one asset class. And so the investors that we work with, when they invest 100K or 500K in one of our deals, that's just one of their allocations with us, and that's just one of their exposures throughout their portfolio, right? So they are likely, very high net worth with 5 million in investable assets or more. So just to caveat what average in this context is, but nevertheless, this average investor, to your point, probably doesn't have all the bells and whistles or the need for all that depreciation up front. In certain circumstances, if people are very savvy or structured well, where they qualify as a real estate professional, which we can talk about shortly, or like the earlier example of a large company exit or some sort of capital gain, that's when you can really do some creative structuring to take full advantage of that $50,000 paper loss, like you said, in the case where you invest 100K. But stripping all that down, saying the most basic situation, if an investor has no outside income that they're trying to offset, that 50K loss in year one will carry over into future years, and it will defer all the income from that investment itself until sale. Until sale, that's when you have to recapture the depreciation. And at that point, a company like ours, we offer the option but not the obligation to 1031 exchange with us into the next deal, which allows you to further defer the depreciation recapture and the capital gains tax.
Yeah, so super important too. When you think about different places to allocate capital, if you're, again, someone who's worth $1 million, $2 million, $3 million, think of the corporate employee making a few $100,000 a year or whatever it may be, right? This is a big piece of it too, is looking at how efficient that tax income is, right? Kind of post-tax income. So the ability to go defer the yield you're seeing on a cash perspective allows you to go budget more appropriately when looking at this, how much yield will actually have on a given year basis. In the future, you can then have the opportunity to potentially exchange that money into a net new deal, right? Bringing that depreciated basis over to a new project, allowing you to go kick that can way further down the road too. So let's kind of pivot as well and kind of talk through, right? That's the traditional retail investor. Now walk through maybe how some family offices you've talked to think about deals like this in general.
Yeah, so when we scale up in size and sophistication, things can get more interesting. For example, we have some larger investors who are especially tax conscious. And so they're looking for enhanced depreciation opportunities. And so we're able to get creative and structure deals where they invest at $1 million or more, and we're able to actually give them a special allocation of depreciation, which meets their goals and can hopefully significantly offset their taxable income. So they're making money day one when they invest on a post-tax basis. So that's something that we do, and I think that's a common strategy for those investing in real estate, because like I said, high net worth people, they already have their stocks and bonds. Those are great investments. They might have some private credit, and so there's a lot of great options out there. But real estate is very unique in the sense that it's a hard asset with cash flow and this tax advantage. And so I know it's maybe not the sexiest thing to talk about all these tax things all the time. People want to talk about the flashy deal profile or doubling your money and all that stuff. But like you said, Sam, it's all about what you take home at the end of the day. So if we spend half as much time on the tax side of things as we spend on the deal side or earning side of things, it's really productive time.
Yeah, it's also too, if you look at, right, anyone from a, high earning corporate person to a family office to, whatever these groups are that have meaningful amounts of dollars, their single biggest expense is taxes, right? So in turn, if you're making $1 million a year and you're in where you are in New York, you'll likely take home what, $520,000, right? Maybe. So in turn, like that $480,000 is a massive, massive, massive expense to go incur. So by putting the time and effort into the tax side of it, there's huge opportunity to go take home more. Right? Again, like not how much you make, how much you actually get to go keep is a huge swing when looking at it.
Another big piece in terms of structuring investment opportunities and tax planning is the 1031 exchange, specifically going into a syndication. So this is something that I would say has increased in popularity, but it's still lesser known. But it's something that we specialize in and are, frankly, industry leaders. We've completed over 150 million in 1031 exchanges for our investors. So what that looks like is, I'm just thinking of an investor, for example, back in California that we know that they are a large landlord in California, but they're getting older and it's a headache to own these smaller properties where there's rent control and there's all these California landlord headaches. And so this investor is selling California multifamily properties and 1031 exchanging the proceeds into an investment with us. And so it sounds simple, but it really has profound benefits because number one, it unlocks a sale for their legacy asset. And when I say legacy, I truly mean it could be a property that they've owned for 10, 20, 30 years where the basis is very low. And so what that means is upon sale, they would owe a massive tax bill because essentially they might maybe bought for $1 million, sold for 10 million, right? It's a huge gain. So selling almost becomes prohibitive if not for a 1031 exchange. But the traditional problem here is that with a 1031 exchange, you need to roll into another deal. But if you're an aging landlord and you don't want to buy another property in California or whatever the case might be, now you have an issue in terms of trying to save on the tax. And so that's where we come in and we structure the deal where they're able to come in as a tenant in common with our acquisition. They're able to participate in institutionally run, institutional grade asset, but they get to be a more passive partner while securing their 1031 exchange.
Yeah, that's huge. We had a conversation actually last week with someone on the same topic, right? A friend of mine, their dad, similar position. They actually own a lot of real estate in California. Similar thing, portfolio worth $10 million or so. And it's getting to the place where it's just tough to go manage, right? And typically what you see is they think their only option is to go sell it, exchange it into net new properties. And ideally go past that basis down to their future kids, right? When they pass away, as that eliminates the whole tax burden of it. It steps up your basis back into normal standard. But that's a big lift, right? Like these are not passing deals on the management side. So as we kind of pivot and looking into the more operational piece, right, as a sponsor yourself, walk us through, before we do that, a few areas where if you're someone and you hit these criteria, like you should not invest in deals like this.
Yeah, I think going back to the main point that we've been talking about is the taxable nature of the investor. If someone is, for whatever reason, tax exempt, for example, an endowment or something like that, then I don't see the strong appeal in real estate. And similarly, if you're non-taxable in some other way, whether it be foreign in Dubai or something like that, it's again not appealing. So I would say that's one pretty obvious one. Another thing is, and this kind of gets into your wheelhouse, is just, where are you in your wealth and career journey? And because the reality is I say this all the time, we are not in the business of making people rich. We're in the business of keeping people rich. So if people want to get rich, do not invest with us because we're not going to double your money in 2 years. We're not going to double your money in 3 years, probably. If it happens, it's great. But really, we're looking to protect, preserve, and double money in 5, 7, 10 years, right? So it's a slow game. It's a preservation game. So if you're not at that stage yet, that's totally fine. But I would say multifamily, just generally speaking, as an asset class, is not going to be the most exciting. The young whippersnappers these days are doing Bitcoin and whatever else that's going on. So that might be more applicable.
Yeah, that's a big thing too, is like, yeah, I think I talked about this a lot offline, is just that you look at like, hey, like we do boring deals. And that's part of the whole thesis, is that you're buying deals that you feel are super stable and meant to go hold long term, which then kind of pivots into other piece of this conversation is one of the biggest reasons kind of being in that seat, similar to yourself too, is that if you're an investor and this is money you'll need in 2, 3, 4 years, do not place it into a place in which it's locked up, right? One of the biggest things that we see is that people underestimate, right? They get very starry eyed about how deals are going to perform. And they think that 5-year timeline is really 2 or 3 years, right? And in turn, they need a capital back more quickly. And there really is not a secondary market for these types of opportunities.
No, definitely not. And what you mean, just to clarify for the audience about secondary opportunities, if you invest with us or some other private placement opportunity that's illiquid, you own a share of a company essentially. And that company owns the real estate, let's say. And you could technically, in most cases, transfer your shares. You could sell your shares to another willing buyer or investor. But just because you can doesn't mean you actually can, right? You legally might be able to, but you only can if there's a buyer. And so typically there is no market for these, there is no buyer. And so it's very hard to find the liquidity there when in search for it. It'll be at a heavy discount. So you're totally right. Liquidity is a major consideration. And what I would say, just what I've learned over the years, is that optionality, which is kind of another way to say liquidity, is just generally super underpriced, underappreciated. So the having optionality, having flexibility is very valuable in life. Just think about the difference between buying a house or renting, right? Buying a house, you are locking yourself up. Yeah, there's tons of benefits, no doubt. But just from an optionality perspective, right? You are giving away optionality. You're essentially giving away liquidity. And people generally underappreciate that. So when you're looking at your life, you're looking at options, preserving optionality is super valuable. However, when investing in really any type of investment, I would say that liquidity is technically a bug, but in some cases, I would argue that it's a feature because humans are emotional, we're fallible, and the market goes up and down. And so oftentimes liquidity can act as a protection mechanism against your own self because, I'm a weak human. If I invest in the stock market and there's bad news or I had a bad day and I'm feeling nervous, I might press the sell button and sell those shares and lock in that loss. But if it's not so easy to sell, because in real estate it's not. It takes months or years to prepare the property for sale. Then you've got to go through a 3 to 6 month marketing process. Then you've got to spend 2 to 6 months closing. It's a long ordeal. And so that can prevent you from making a rash decision.
Yeah, that's super important too. I know you and I have really similar beliefs relates to renting versus owning as well too, right? In terms of the lockup of capital that you have to go put a down payment on a place, especially in a tier 1 or tier 1B type market, right? New York's definitely tier 1. I'd say Miami is more of a B plus A minus in terms of pricing as relates to market as well. And what you find is that in these higher priced areas is that you have a lot of capital locked up to go secure a place. You have very low cap rates in which you're buying. So in turn, your rent is far lower than your mortgage would be. You also have the opportunity cost of if you're able to allocate your capital and get a return that likely is also eating into your net return there as well. And then I say lastly, you have the, hey, it's time to go move. You add another kid, you have a job opportunity, like whatever it may be. If you want to go change locations, that transaction cost itself is massive.
Massive. Yeah, I would put owning a home in the category of super awesome, great thing to aspire to do, especially without a mortgage, right? Owning a home without a mortgage is such a financially irresponsible thing to do, right? You could generate such a better return on your capital by getting a mortgage and using the difference of the capital to go invest at higher rates of return, or renting and using the down payment instead on higher rates of return, right? So owning a home without a mortgage is financially irresponsible. However, it's a really, really cool thing to aspire to do, and everyone should aspire to do that. But like I said, I would put that in the category of stay rich, not get rich.
Totally. And there's a value to it too. Like I know I talk to my mom frequently, right? And she's over 60. And for her, the thought of owning a home in cash is super comforting, right? Whereas I know that, hey, I can likely, with a very high confidence rate, go outperform the return of renting, reallocating capital, arbitraging that lower payment overall. But there is a huge, huge value. I think the home piece of it is much more of a family and emotional decision than it is a financial decision.
Definitely.
And so let's now kind of pivot to the sponsor side, right? You built a company, you've got what, 100 and change employees now in the company across the board?
Over 200 with our on-site teams.
So walk through what that's like. And I think it's a really important topic too, is that I think you all have done a great job on building a company for the long, long term, right? You're really young, while the team is fairly young, but I think how you operate shows that this is what you want to do for decades to come in the future. And in turn, I think you've done things that maybe hurt you in the short term, financially, personally, but allow you to go build a really good company for decades to come in terms of reputation, branding, systems, process. So walk through what that's like to go scale that, but also the trade-offs that you have to be comfortable making to get to a place in which you are going to go get to.
Yeah, so I mean, we recorded a podcast a while ago talking about the life cycle and the scaling element of a multifamily operator. So I'll just kind of recap that briefly. Basically, when you first start out on the road of, okay, I want to, buy real estate, I want to raise capital, I want to manage it, it's very exciting, and you can really, so long as you have the capital behind you, you can get started, and it's a very capital not it's a capital light business because you're raising the outside capital. You don't really have to buy, with your own internal funds equipment, or you don't really have to hire that many people at first. And so you're able to have high margins, and you're able to acquire a handful of properties and start managing a small portfolio, and that's exciting. But then you get to a certain level where you are now building a larger portfolio, you need more people, and then you start realizing, oh shoot, I need to bring property management in-house, I need construction management, and I need to bring accounting in-house. And so now you need, instead of hiring one person every year, now you need to hire, 10, 20, 50 people, 100, I think we're going to hire 100 people this year. So it just, once you start vertically integrating and incorporating more elements of the business, your hiring needs start growing and the scale of the company starts growing. And now all of a sudden, you used to enjoy this 80% margin, you're making money, to now your margin is zero because all the money's going back into the people, into the growth of the business. And that's a difficult thing for a lot of people. And I think this is not unique because every vision, anything that you're trying to build, you might kind of see this initial like excitement, and then the valley of despair, you might hit the wall. And in order to push through that, you've got to, like you said, be able to commit a lot of time, a lot of resources and patience to get to the other side of it.
Yeah, I mean, we've even seen it internally on our end too, right? On a smaller scale. If you look at Silverman Capital, where it's been a very, very, very bootstrapped small firm that has insane margins when you look at revenue coming in relative to the salaries we have, the expenses we have too. But if you want to make that next jump to be a sustainable long-term company, you'd be really comfortable taking 1, 2, 3 steps backwards as it relates to taking cash home to potentially take far, far more out and create the experience that your partners, investors, customers, etc. will have. So on your end, kind of how do you balance that? I think like it's a big mental thing too, of saying, we can go take home far less than we could, right, to go build something that's much more sustainable. I think this applies to a lot of industries, right? I have friends at home service companies who are adding new locations, growing, right? So I think it kind of across the board in whatever industry that it is that you're in.
Yeah, I think it's, I mean, people look at it different ways. I would say for me, it's like there's no other option. I woke up for some reason today so hungry and just writing in my journal, thinking in my head, texting. I'm just spamming all my employees like, we need to do this, we need to do that. Let's go, let's double our goals. So I think for many people who are in this seat, I wouldn't say I'm as ambitious as Elon Musk, that's for sure. But I think if you are going to be in this seat, you need to make sure that you are ambitious enough to strap in and go for it. Because if you are thinking, oh, I like my corporate job right now, but I want to invest in real estate and I don't want to invest passively because I don't want to pay the fees. I'll just start a multifamily syndication company myself. That's probably a bad idea because it's going to be very, very hard and it's going to require all of you. So that's where I think it just kind of is a bit self-selecting where, like in my brain, there is no other option.
Yeah, and that's a really important thing too. So I want to pivot a bit again, where I've been listening to a ton of David Cerna in terms of the Founders podcasts, and where in that podcast, or not, to those who aren't familiar with it, he reads a book a week, interviews these founders who've been in the same company for decades, right? If you want to be really impressed, go listen to the one on Dyson. It's insane. And like what I've really found, I think you're a great example of this too, is that people who go all in on one thing have and do it for a very, very long period of time, those people typically are the one most knowledgeable, two most profitable, three had much generational wealth, and four are just the biggest experts in that single field that they can go be in. And reputationally, that follows you in a big way. So on your end, like, how do you think about what you're doing? How do you think about, people who may be figuring out what their one thing is?
Yeah, I love this question because I think my perspective might calm some people's nerves a bit because my perspective is kind of blunt that it's really not super critical what you pick. Sure, there's some stories where, I don't know, like, if the founder of Microsoft just so happened to be born in this year and he was growing up in Seattle where these computers were at this laboratory and it just all worked out, right? Sure, there's maybe those types of stories, but I think generally speaking, just pick something and go with it, right? Don't labor over this decision and spend years and years dabbling. Try to figure it out as fast as possible because, like you said, the sooner that you go down the path of putting in the 10,000 hours, the 100,000 hours, the better off you'll be. And it won't be as material what you ended up picking so long as you stick with it. So, is multifamily for me the absolute best business that I could be in? No, I'm sure it's not. But will I do very well? Will I be financially fulfilled? Will I be personally fulfilled? I do believe so.
Yeah, you're spot on too. Like I even thought think of the analogy too, right? Like take the barber I know you go to in New York, right? Which I've been to as well. And this guy is the traditional barber, I'm sure probably makes 30, 40, 50 grand a year, if that. This guy probably makes three, four, $500,000 a year because he is so good at his craft. And while that's not it may not be a lot of money to some people listening to the show, relative to the average person doing that craft, that's 10, 12 times what they can go make. So it's really showing that if you truly are a master in what it is that you're doing, you will out earn that person to a massive degree who's very average at doing it. I think in any field that you're in, right, the expert will always make exponentially more than the person who's average at doing those things. I mean, myself too, I struggle with where I do two, three, four things at the same time. I think it's become a lot easier. Life's a lot more calm when you focus on one thing and get really, really good in that one thing. Like when people think of you, they think of you guys buy multifamily in Texas. That's it, right? Which makes your life dramatically easier to go get to the market, have conversations, build reputation, etc.
Yeah, reputation is everything because if I'm the smartest in the room or I'm the expert, but nobody knows it, it doesn't matter. I can't monetize it. So it's one, being the expert, but it's also two, being known as the expert, right? And you have to have both. And so it's hard to become not that I'm saying I'm a household name, but it's hard to become a household name overnight. You have to put in the hours and work over time. And what gets me so excited is I know that every day that we put in, every year that goes by, we're we're just getting it's a compounding effect where we're getting harder and harder to compete with because we've been in business for longer and longer, and then we have more and more reputations or relationships with our investors, and those relationships are not over months, they're over years and then soon to be decades, and that's a very, very big moat.
Yeah, and it's also something too that, I think a lot of it's actually similar to real estate, where again, real estate's much more of a buy and hold type asset class in general, especially multifamily, where if you look at it is that time in market will usually fix a lot of things, right? Certain deals, even if you didn't buy them perfectly, if you can hang on to them long enough, those deals should be profitable at some point eventually in the future, right? I think it's similar to the business itself, where if you can go be in business for a very, very long time, doing the exact same thing, the likely scenario is you'll end up, one, in a very good financial spot, but two, with a very sustainable type company as well. Cool. And before we wrap here too, what piece of advice do you have for two kinds of people, right? One being the investor, and think the retail investor, right? This is a mid six figure corporate employee who's thinking about how multifamily can fit into their portfolio itself, whether on both the active or the passive side. And second, what advice do you have for someone who may be looking to go break into this space and deciding if they want to go down the same route that you did and actually building out a true multifamily shop as well?
Yeah, on the investor side, my advice would be to spend time with potential operators and diligence them and their investment thesis and make sure that it sounds cliche, but they, as a person, their company resonates with you and aligns with you, kind of from a moral perspective, business perspective, and things like that. And like with any relationship, it takes time to figure those things out. On a first date, you don't automatically, learn if you can trust that person, or, if they're humble or cocky, or, whatever it is, right? So it takes time. So I would take the time to get to know people. And then on a more brass tacks side, I would understand investment strategies better and understand, are they in alignment with your thesis? And also, you have to understand that your investment strategy can and will change over time, which is appropriate. One, it can come from learning. Two, it can come from just change in preferences as your, wealth changes or your investment goals change. So ideally, scaling with people is better. It's riskier and it's a headache to partner with a bunch of different managers, and you don't have as much due diligence with them. So I would take the time and try to go deeper with fewer, in terms of both operators and investments. And then for those listening that are considering going down an entrepreneurial route, starting up your own, fund or investment manager or real estate operator, I could spend all day giving advice. It's an odyssey, right? I think Alex Hermosi says it well, where he loves business because it's the number one self-help tool. Like, you learn so much about yourself by being in business, right? You're tested in all the ways that you don't want to be tested. So I would say, number one, there's a lot of options. So you don't have to be the founder to ride on this journey. I have a lot of amazing people on the team that are, sitting co-pilot, sitting, a couple steps away. Maybe their life is a little bit less stressful. Maybe they get to focus on what they really like to do. There's a seat, not necessarily for everyone, but there's many seats available on the rocket ship. So in some cases, and for some people, it's just, the value is just being on the rocket ship itself rather than leading the charge. And so that's not to say that if you are resolved, or you're determined to be the founder, to be the CEO, that doesn't mean you necessarily have an ego, or maybe you do have an ego, and that's fine. Do your thing. But I would say that figuring out, kind of like, honestly, truly, truly figuring out where you want to be. Don't just be founder CEO just because it looks good on LinkedIn or because you want to impress your friends or anything like that. These are life decisions, so that would be my advice.
And lastly, before we hop to, like, what's one thing personally that you spend money on that you feel is like a splurge or a luxury that's actually worth it?
Oh, wow. That's a fun topic. I like spending money. So, well, massages are super cheap in New York, at least. Chinatown, you can get a massage for $50. And, on my Oura Ring, I get a lot of restorative time. So anytime that I'm not being stressed out, and I'm being restored, that's super valuable. So I think that's a no-brainer. I think flying first class, it's like flying first class, flying private. Like people talk about those as unlocks or like, oh, once I did it, I can't go back. I think there's maybe some truth to that. I mean, I don't fly private, but like first class is nice. But I don't know if it's actually super, super worth the money in many cases because it is a lot more expensive. So I feel like that's a cuspier one. And then I would say that if you are if you're a younger guy or gal listening to this, like us, ambitious, growing our businesses and stuff, I think that investing in your image is invaluable. Uh, Such a high return on, as the young kids say, looks maxing, right? So making sure that you have good haircut, you're well groomed, you have good outfit. You don't have to wear a suit and tie like me, but just having a look, being cleaned up, well fitted, put together has one of the highest ROIs.
Cool. Rob, thanks again for coming on.
Thanks for having me.